Hello, this is Josh Belk with the Belk on Business podcast. Hope you had a wonderful holiday season. This Christmas was yesterday and coming up on the New Year's holiday. And hope as this year end wraps up that 2023 was a good year for you and 2024 will even be better. Today we're going to hop into a topic, one that generates some conversation, I think may generate more confusion sometimes for people as it relates to these hobby rules and taxation. So the title of today's podcast is, when is my business considered a hobby? And or is my business, or what I think is a business, is it considered a hobby? And and kind of working through these rules, and some of these rules are stated, others are more kind of instructional or maybe guardrails that are put up in regards to a determination on whether or not what I am doing is truly a business. And treading or working through those rules can be a little bit confusing. And I'm going to probably not give a great deal of clarity because every situation or situations may be a little bit different, your situation versus somebody else's. But kind of just giving a little bit more of information, a little bit more of an overarching type of a theme to this particular topic. So, and this is an area that the IRS does look at, especially we're seeing more and more audits, especially of taxpayers as it relates specifically to this. And of course, with the whole initiative of auditing more income taxpayers. I was actually reading an article on this particular topic this past week, and it had mentioned that individuals that are making over $10 million a year are seeing about a doubling of audit rates. And so that number is about 8% as of right now that they're auditing. And this is one area that they look at. There's a number of others that they look at, but this is one area they do look at, and whether or not there's a loss on the tax return, mainly on a Schedule C, that maybe or should be considered a hobby and is not truly a business. So for some people, they earn income. They may have a side hustle or something they have going on, and they think, okay, it's just something that I just kind of dabble with, and I don't need to claim it. So that's kind of one end. It's just a hobby. It's just something I do. Maybe I have, I do something crafty and I sell it, or I have an Etsy page, whatever the case may be, and I go through and I make things and I sell them, and I just simply don't claim the income. And in your head, it's just a hobby. It's just something you do on the side to try to make a little bit of money. Now, the question becomes, what is the intent? A lot of kind of goes into it. But however, if you are earning money in that particular capacity, it does need to be claimed as income. Okay, because gross income, when it comes to the Internal Revenue Code, it generally includes all of the income that you receive, even if it's something that you don't regularly do as a kind of an ongoing trade or an ongoing activity. So it can be one of those things. You're making money doing something. It may just be a short period of time, and you just kind of consider it a hobby, something you do on the side just to earn a few extra dollars. The IRS, if they were to dig into that, is going to say that indeed that is income. But that's not necessarily the big problem or the big issue that's missed. Generally, it goes the other direction. That is someone who thinks that they have a business, but the IRS would look at it and consider it a hobby or question on whether it is a hobby. One of the articles I was reading gave a couple examples as it relates to especially higher income taxpayers. And someone may go and buy a yacht or buy a plane, and it's primarily that they use and they use personally or whatever the case may be. And so occasionally they'll rent it out to other people, and then they'll want to try to write the whole entire thing off. And the IRS looks at it. Okay, well, what was the intent? Is this really considered a business loss? So let's talk a little bit about this. So the section of the Internal Revenue Code that kind of speaks to this particular topic is Internal Revenue Code Section 183. And in this section, it does allow for you, even if you do have a hobby or a business that would be considered a hobby, it will allow you to deduct the expenses up to the income that you earned. It's just that excess that you would not be able to use. So say, for example, you have something going on on the side. So maybe you go to the local gym and you train some people. Maybe you go through and you make some stuff in your garage and you go through and you sell it. And so you have these kind of side types of things. And it's just considered hobby. It's not something you're going to be regularly ongoing for years. You're going to try to create a business out of it. It's just something that you do. So in those situations, if if it's not something you're going to do regularly, you can simply just go through. You're going to go ahead and recognize the income, and you recognize the expenses against that income. You just would not recognize the excess, unless it is something that you're going to be continuing doing year over year with the intent to make money, with the intent to actually profit from that particular activity. Most people kind of get hung up on this 3 out of 5 rule, meaning that you need to show income in 3 out of 5 years, otherwise it's considered a loss. And that's just one of the areas that does get looked at. That line, as far as between hobby or business, it can be blurry. It's a quote in regards to that from the IRS. Says it often can prove highly difficult to figure out the difference between a legitimate business that is devoted to making a profit and an activity that is not. And so, and it says this in one of the IRS in an audit technique guide, where it gives basically direction to auditors as to what activities are or are not considered income activity or activities intended to make a profit. And it continues on, says, for an endeavor to be considered a business that has to be carried out in a business-like manner. And so if you do have a business, it does need to be carried out in a business-like manner. Do you have a business structure? Do you have books? Do you have records? Are you invoicing clients? Are you, these types of things? Do you actually have a business structure in place? Or is it just something you just kind of just do on the side, and you take cash from people and you stick it in your pocket, or they cash app you money, or whatever the case may be? Okay. So if indeed it is a true business, and you're looking at, okay, I want to do this thing. It may not be my full-time gig, but it's something I'm going to continue doing going forward. I may have losses, especially in the startup phase. Make sure that you're operating that particular activity in a business-like manner. So, and part of that, and it's a quote here, does include complete and accurate books and records. And so the taxpayer must put in the time and effort to show they intend to make it profitable. And it has to depend on some income from the activity for their livelihood. So you can kind of see that the IRS in the audit technique guide does outline some of, in a narrative standpoint, what the auditor is to be looking at. So do they have books and records? Do they intend to make it profitable? Or are you just getting into it to write things off? Okay. And then they also have to consider if they do have losses, if there were certain things out of their control, or if they were just in the startup phase of business. And so the why the losses ended up coming into play also plays a portion of this. And so the IRS does say that a business must show a profit for 3 out of its first 5 years of operation. Otherwise, the losses generally will be disallowed. Yeah, but this is, like I mentioned before, only one area or one part of the entire picture that the IRS will look at. Now, that is a big part of it, okay? But then the IRS is going to dig in a little bit deeper. So questions that you as a taxpayer, if you have some this type of activity going on, is something that you must consider. And questions that you're going to have to answer. First of all, have you made profit from similar activities in the past? So if you have something that you're doing, you stop doing it, and you did this at one point in the past, and you're deciding to pick it back up, and that could be a consideration. Does their current endeavor profit in some years, and by how much? So if you kind of have this activity going on, is it profitable in past years? So you may end up in a situation that was profitable for a few years, then ends up not profitable for a couple years. Is it a situation to where you were intending to make a profit, but maybe some things went on that were outside of your control? That's one factor versus, okay, I just kind of, now I'm just going to kind of just piddle around with this and continue to write off, expenses that I have and then just try to help reduce my taxes by saying that I'm continuing with this activity, although the activity truly isn't one that is meant to make a profit. And then also, as it was mentioned here, is to contribute to your livelihood. And then what are you doing and why are you doing it? Okay, so and of course this is true in any business. You need to have a purpose. You need to have a why. You need these types of things. And here's kind of a very one practical area to where, okay, what is the mission of this particular business? Why is it that we're doing this? Are we doing this truly to bring value to a customer or to the consumer to make money, or am I doing this just simply to reduce my tax exposure? Okay, and so there are legitimate areas you can go through and deploy capital to reduce your tax exposure, but to have something that you think is a business is truly a hobby is not one area to reduce your tax exposure. And so the IRS audit technique also adds that examiners should be watching for other details, other years which the businesses record little or no income or had large losses. Are large losses simply just being used to offset income? Are there elements of the business that have a recreation or personal pleasure aspect of it? Kind of going back to the earlier example with some that was in this article as it relates to higher income taxpayers, a yacht or a plane or something. So when you're doing those types of things, if you're running a travel company or whatever the case may be, you're going to advise clients on travel. Okay, now you don't see a whole lot of travel agents anymore, but are you getting in the business just simply so you can get discounts on travel? Sometimes we see this in real estate. People get into real estate just to get a house that they can put family members in and try to write it off. Okay, we've seen this happen before as well. So what is the purpose of the activity? Why are you getting into it? Is it showing a profit? Is it not showing a profit? Why is it not showing a profit? If it isn't showing a profit, intent does matter. And Section 183 does say that if an activity is a not-for-profit hobby, then the taxpayer can't take the deductions for it. And so that's something that you need to be aware of. The Treasury Inspector General for Tax Administration said recently that businesses may not have been engaging in the activity for the primary purpose of making a profit. Therefore, the losses will be disallowed. So they continue coming out and speaking against this type of thing. It's becoming a real issue, a real problem, especially in recent years with the PPP and the idle money. All of a sudden, you had all these kind of fake businesses, I will say, that were popping up. And so in some of this, oh, wow, I can not only is the government going to give me money, but now I can write off the losses. And so they'll continue kind of this bogus type of activities just to try to recognize the losses. So that, and also with some of the wealthy also using similar types of techniques of taking something that otherwise would be considered a hobby and trying to make it appear that it's a business and writing off the excess losses. Regardless of the situation, whether high income taxpayer, low income taxpayer, all of these particular considerations do need to be taken into consideration. So if you're getting into something, making sure that you have a reason why you're getting into it. You have good books and records. You are operating your company as a company, your business as a business. The intent is there to make a profit, and that you're acting in a way to push that business forward to make a profit. Understanding most businesses in the startup phase do lose money, but if you are doing these other types of things, and the reason why that the business isn't succeeding or isn't showing a profit on the front end is because you had to go and you had to buy some equipment on the front end, and you're taking depreciation, so it creates these losses. It's a situation to where you invested a bunch of money into advertising to get your name out there, and so during the course of the year, you start to see revenue starting to generate. Guess what? Those are things you were out there, you were trying to make a profit. In those situations, you, in all probability, don't have a hobby. But if you aren't doing these types of things, you may want to consider whether or not you should continue on with the activity, number one, but also when it comes to the preparation of your tax returns, that you do have these bases covered if indeed it is a business. If not, make sure that you are recognizing the income, recognize the expenses up to the income, and not expense or deduct any sort of expenses beyond the income that was received. This is Josh Belk with the Belk on Business podcast. Hopefully this particular podcast did bring you some value. If you haven't already, please consider subscribing. Have a wonderful day.